All right, what's going on, guys? So let's get right into today. So overall, pretty interesting day as a whole. You know, these first bar one is always a really interesting bar, especially when this kind of scenario happens. You just get a really big. Let me see if I can figure out how to. Oh well, I want to figure out how to make these bars a little. There we go, that'll work. So bar one, huge bar, and it's so easy to think, oh, we're bound to just go straight up, test the tight trading range. It's a gap. And often when you get these big bars, they typically go sideways a lot. We gap down, it's a big bar, big risk. So if you buy and put your stop at the low, 1 times your risk is up here. Is it a 60% trade? I don't know, maybe. And the problem with this is most of the time, you hear I'll talk a lot about this, is you'll often get a pullback close to 50% of the bar, because if you did, in theory, you could, if you buy somewhere in here, twice your risk is here, you'll get 2 times your risk. Or you'll have a 60% chance of price going back up to here before it goes to here. And again, this is kind of the tricky part with always in. It's so easy. We had it over here where you get a big bar one and we just reverse. Here was a little different because we gapped up, and again, most of the time, 20% chance bar one is the low of the day or the high of the day. Over here, maybe the odds were slightly better, arguably. And I say that for the simple fact that we gapped down, therefore you're buying at a discount. Now, there's nothing wrong with buying above bar one. You just have to be aware of a few key features. If you're going to buy, think about it like this. What do you want? You want follow through. You want to see bars like this that are big bars. You know, so when you see this and you see this, that should be a red flag. You're going to have a lot of traders, because what are they doing? They're buying and scalping out. Why aren't they holding? If they were holding, they wouldn't be scalping out. We'd be going higher. So it's a warning. And when that happens, you're going to see traders who will look to scalp out. Now, you could say, gee, well, it doesn't look like they did. Well, they are, though. They're hesitating. Some traders will say, gee, I'll buy the low bar one, scalp out for a little bit. Maybe I'll, it's a terrible low one, don't get me wrong. So a limit order trader very well may think like this. Hey, I'll buy this low. I'll set a target up here. I'll put a stop a little below this. I've got a 1-to-1 risk reward. Boom. And we have a low too. And you're thinking, gee, why did this happen? Well, think about it like this. On a 1-minute chart, I know it takes a second to kind of go back, but it's definitely worth it. We have a big rally, okay? We have a push-up, pullback, a second push-up, pullback, a third push-up. So it's a double top, it's a bull break out of a double top, and we're starting to reverse down. Now, you can see that on the 5-minute chart, though. We have a rally and a pullback. We have a rally and a pullback. We have a rally and a strong sell-off. 50% of days. And I think it's super important to, and I'll finish my 50% in a second, super important, watch Trading the Open. Al has a ton of videos over it. There's a 50% chance that the opening move reverses. And excuse me, I actually have that wrong. 50% chance the first swing fails and reverses. 80% chance you get some sort of minor reversal in the open. And 20% chance you get a trend from the open that just goes straight up or straight down. Now, the tricky part with today is if you're trading on, and this is where you have to be very careful about always in. And I've discussed that on the Brooks Price Action website with a few people. And this is kind of their point that they're trying to make, and I totally agree and totally understand, is you cannot be concrete and just mindless with trading always in. You can't just say, oh, I'll buy, and then I'll sell, and maybe I get out here. In that case, it's probably okay. But hypothetically, what if you were to say, it's always in long, I'll buy, and then you say, maybe you say, oh no, it's always in short, I got to sell. And then if you're lucky, you're smart enough to get out above the second entry buy, double bottom, maybe you get out up here and you just get clobbered. So that's the problem. Just because it might be always in short here, you got to be careful. There's nothing wrong with getting out of shorts here and looking to buy above this bar. Nothing wrong with that at all. There's nothing wrong with even selling here. But you have to understand a very important thing. The institutional traders, and really plenty of traders are going to do this because it just makes sense. It's the same concept over here. So I'll just draw it both to give you two examples. A lot of traders will buy the close of this bar and they'll buy more at the low or near the low and set a target way down. Plenty of traders will buy the close, they'll buy more lower and set a target way down. Look what happened here. They buy the close, they buy more lower, and magically, why do you think we get out at this close? So that kind of takes me back to another point. Always in is a great starting point, and quite frankly, if you cannot understand always in, then you're not going to understand the other pieces. I'm not saying always in is a great thing to trade all the time. It's not. So if you buy here, you got to be just quick to get out. Maybe you take the loss here, you buy again here. That's not a high probability buy either. So you're better off getting out. This is a very reasonable buy and a credible buy. It's a double bottom, second entry buy. You bet on some sort of measured move up. We're rallying. Strong rally. Odds are the first reversal down will fail, but the stop's far away. It's a second entry short, possible second leg trap, but it's probably too strong. The market will have to go sideways, and the bears really need a second entry short. They don't get it. They get that, but that's after that many bull bars. Probably going to fail. Now, one of the interesting things with that is I do believe this. Now, management's kind of tricky, but if you, I'm actually curious, I want to see, yeah, you get stopped out right there. But if you were to sell and then look to sell more below a bear bar, you could probably get out of break even. And in this case, it basically did let you out. So you sell here, you sell more here, get out around break even. But tight channel, still pretty tight, not below the moving average here. You got to get out of short somewhere in here, more likely than not, probably below that bar. Even though we may go sideways, it's probably going to evolve into a trading range. Reasonable sell here, growing and selling pressure here. Sellers above these new highs probably will get a deep pullback, and we may fall below a higher low, such as that. But it's a tight enough channel. This is probably going to turn into a trading range. So traders will look to buy around here. And in terms of always in, you're long. If you bought here and you held through this, or you bought here and you got out below the bar, no big deal. You made a profit. Who cares? You don't have to get out necessarily below here. And if you do, you get long above here. And maybe you get out here, and then maybe not really easy to get long there. You may get a second leg up. But either way, don't look to sell. Don't sell this. Don't sell that. Don't sell the close of this. Wait for follow through. You get the second leg, but no follow through. You buy somewhere in here. Strong rally, new high. Falling below a major higher low, so probably some sort of broader channel. This rally looks a little weak, kind of parabolic. Leg up, pull back, leg up, maybe get a little bit more. Best looking bull bars, certainly in the past 20 bars, probably exhaustion. Gap's probably going to close. We're getting very close to a target. It's possible. One could easily argue that the target is this. Other traders are going to argue the target is the low to here. Already obviously achieved. Starting to go sideways. And there we go. So really pretty much a trading range for the end of the day. And we started rallying, started channeling, went sideways. Now we're in a trading range. So overall, interesting day. The open of the day was probably, as with most days, typically look for a swing trade on the open. It's your best bet most of the time. So that's all I have. Thanks for watching. Comment if you have any questions for probably reasonable swing trades. All through here, pretty clearly always in long. This part was confusing. But once you probably had this bar, this follow through, you're probably always in long for, at least somewhere up into here. So for the most reasonable swing trades, you can buy here, and if you did, maybe you get out below here. It's kind of iffy on the, is it reasonable? Yeah, but again, there's usually a 30% chance that it's the low of the day, so you're typically better off getting out quickly. Just as over here, we had another day like that, kind of like here. You know, there's just always that risk if you sell, you get out quick. You buy here, we had immediate follow through, so it's easier to hold it. Let me just go back to the day. So you probably buy here, no reason to get out. Maybe you get out below here. You can buy here, but probably need a wide stop, may get a second leg down in the moving average. Get out on a new high, maybe get out below the bar. I wouldn't necessarily buy there, possible second leg down, but certainly can. Reasonable to buy here, multiple pushes down, testing the bottom of a trading range. If you did get out, probably just get out somewhere in here. Here's a high one buy at a new high. After two great looking bull bars, it's probably going to fail, so get out above that high. It's also got a big tail. And probably all I'll do for the rest of the day. So thanks for watching.